surpassing your full-time job with this portfolio of 3 dividend growth ETFs. Most people trying to live off dividends make a huge mistake. They go straight for the highest yields, thinking that's the fastest way to financial freedom. But what happens next? Dividend cuts, stock crashes, and lost income. Just like that, the dream falls apart. What if I told you that you could turn $10,000 into $4,800 a month with a different strategy? Dividend growth ETFs. Sounds like a dream, but it doesn't have to be. In this video, we're breaking down 3 powerhouse ETFs ranked from solid to absolute game changer that strike the perfect balance between dividend yield and long-term growth. We'll go over how they work, what they hold, and why they've been cash machines for investors. And here's the best part. By the end, you'll see how an initial $10,000 investment can snowball into over $4,800 per month in passive income, possibly even outpacing your full-time job. Sounds crazy? Stick around and let's get into it. Everyone loves the idea of getting paid just for holding stocks. Dividend investing is like turning your portfolio into a money-printing machine. But here's the thing, chasing the highest dividend yield isn't always the best strategy. In fact, it can be a trap. Those ultra-high yields, they might look juicy, but they often come from struggling companies that can't sustain those payouts. Before you know it, the dividend gets slashed and the stock price tanks. Ouch! That's why the real magic happens with dividend growth. Instead of just looking at how much a stock or ETF pays today, you want to focus on how fast those payments grow over time. Think about it like a snowball rolling down a hill. A small, steady dividend that grows year after year can eventually turn into a massive stream of income. And unlike those sky-high yields that crash and burn, dividend growth stocks and ETFs tend to be backed by strong, reliable companies. Let's break it all down. VOO, or the Vanguard S&P 500 ETF, is one of the simplest yet most powerful tools for building long-term wealth. Think of it as the ultimate set-it-and-forget-it strategy. Why? Because it tracks the S&P 500, an index made up of the 500 largest companies in the US. These are the big dogs, the industry leaders, the companies shaping the global economy. If you believe in the long-term strength of the American economy, VOO is one of the best ways to tap into that growth. Now let's talk about what's under the hood. VOO is heavily weighted in technology, with big names like Apple, Microsoft, and Amazon leading the pack. It is no surprise that tech makes up about 24% of the fund, which makes sense because these companies have been the driving force behind market growth for years. But it's not all about Silicon Valley. Healthcare, financial services, and consumer cyclical stocks also have strong representation, with giants like Johnson & Johnson, Berkshire Hathaway, and Tesla playing key roles. This sector mix gives VOO a solid balance between growth and stability. One of the best parts about VOO? Its dirt cheap expense ratio. At just 0.03%, it's basically free to own. Compare that to actively managed funds that charge 1% or more, and you're keeping way more money in your pocket over the long haul. That's a game changer when you're compounding returns for decades. Now let's break down the numbers that make VOO such a powerhouse. The dividend yield sits at 1.35%, not the highest out there, but here's the kicker. The dividend growth rate is 5.45% per year. That means your payouts are steadily increasing, outpacing inflation, and giving you more income over time. And let's not forget about total returns. Historically, VOO has delivered an annual return of 13.74% on share price appreciation alone. That's the kind of long-term growth that can turn a modest investment into serious wealth. Now let's take a peek into the future and see what a VOO investment could turn into. 5 years in, your dividends are still warming up, bringing in $280 per year. Not life-changing, but hey, it's growing. Now fast forward to 20 years and things start getting exciting. Your dividends are pulling in $4,600 per year, or $400 per month. That's a car payment, groceries, or a nice vacation covered just from passive income. But the real magic happens at 30 years. At this point, you're making $34,000 per year, or roughly $2,800 per month. That's full-time income without lifting a finger. And let's talk about that portfolio value. In 30 years, your $10,000 investment could turn into nearly $925,000. That's the power of compound growth. The longer you stay in, the bigger the rewards. Still doubting the power of dividend growth investing? This next ETF kicks things up a notch to get you more in passive income. VTV. VTV, the Vanguard Value ETF, is all about one thing: solid, time-tested companies that might not be flashy, but know how to deliver consistent returns. Instead of chasing the latest tech hype or high-growth plays, VTV focuses on large-cap companies that are fundamentally strong and often pay steady dividends. Think of it as the reliable blue-chip powerhouse of your portfolio. Stocks that have been through recessions, market crashes, and still come out stronger. The beauty? These companies are often undervalued, meaning you're getting quality businesses at a discount. Now let's talk about what's under the hood. VTV's holdings are dominated by financial services, healthcare, and industrials. Heavyweights like Berkshire Hathaway, JP Morgan Chase, and United Health Group top the list, making up a solid chunk of the fund. These are companies that dominate their industries, generate massive cash flow, and have strong balance sheets. Looking at the sector breakdown, healthcare leads the way with over 21%, followed closely by financial services at 20%. That's a strong defensive mix, perfect for investors looking for stability while still capturing long-term growth. One of the best parts about VTV is also the expense ratio, with an expense ratio of just 0.04%. Now let's talk about the real reason people love VTV, the dividends. It currently has a dividend yield of 2.27%, which is significantly higher than growth-focused ETFs like VU. But it's not just about the yield, it's about the growth. Over the past decade, VTV's dividend has grown at a rate of 6.68% per year. That means even if the yield seems modest now, over time, it snowballs into something much bigger. And let's not forget the share price appreciation. Historically, VTV has delivered an annual return of 12.46%, meaning it's not just a dividend play, it's a long-term wealth-building machine. Now imagine parking $10,000 into VTV and just let it ride its own wave. In 5 years, your portfolio has already doubled to $20,000, and you're pocketing about $400 a year in dividends. Fast forward to 20 years, and things start getting serious. Your initial investment has ballooned to $180,000, and your dividend income is paying you like a side hustle, $500 per month, or $6,200 per year. But the real magic happens at the 30-year mark. By then, your portfolio is worth an eye-watering $880,000, and your dividend payouts? A staggering $3,400 a month, which is nearly $41,000 a year. That's more than what many people make working full-time. And the best part? You did nothing but stay patient and reinvest those dividends. You've even seen VU's explosive growth and VTV's steady cash flow machine. But there's one more, an ETF that will supercharge your portfolio to the next level. SCHD. SCHD is a powerhouse when it comes to dividend investing. It's not just about picking high-yield stocks, it's about quality. SCHD tracks an index of U.S. companies with a strong history of paying and growing their dividends. But here's the kicker. It also screens for financial strength, making sure the companies can sustain those payouts. That means you're not just getting dividends, you're getting reliable dividends. Now let's talk about what's under the hood. SCHD is packed with some of the most solid dividend payers out there. Lockheed Martin, AbbVie, BlackRock, and Coca-Cola are just a few names leading the charge. These companies aren't just sending out checks to shareholders, they're also industry leaders with strong balance sheets. And when you look at the sector breakdown, financial services takes the top spot, followed by industrials, technology, and consumer defense. That's a mix that balances stability with growth. And it's a key reason why SCHD has been such a strong performer over the years. And here's something that really sets SCHD apart. The expense ratio is a ridiculously low 0.06%. That means you're keeping more of your returns instead of handing them over in fees. Over the long run, that makes a massive difference, especially when paired with the fund's stellar dividend yield of 3.79%. That's right, nearly 4% just in dividends. Even better, those payouts have been growing at an average of 12.21% per year. That's not just income, it's income that's outpacing inflation and compounding over time. Now let's talk about price appreciation. SCHD isn't just about dividends. The stock price has been climbing too. Historically, it delivered an annual return of 10.21%. That means you're getting a mix of growth and income, the best of both worlds. SCHD really is a no-brainer. We mean it's a favorite among dividend investors for a reason. It just works. Now let's talk about how your SCHD investment could grow over time, and trust me, the numbers are wild. Say you put $10,000 into SCHD. Sit back and let time do its magic. In 5 years, your dividend income has already climbed to $725 a year, and your portfolio? It's worth nearly double at $19,000, all while paying you to hold it. Now let's push further. At 20 years, things start getting really exciting. Your yearly dividends have exploded to $9,000, meaning you're collecting $750 a month. But here's the kicker. Your portfolio isn't just throwing off cash. It's grown to a whopping $168,000, and that's with just a one-time $10,000 investment. The power of reinvesting dividends and compounding is putting in some serious work here. But let's take it all the way. After 30 years, your monthly dividends are a jaw-dropping $4,800. That's almost $58,000 a year, basically a full-time income, and you didn't have to lift a finger after making that initial investment. And your portfolio value? Try $842,000. That's nearly $1 million from just letting your money sit and grow. And there you have it, 3 powerhouse ETFs that make dividend growth investing a game changer. Whether it's VU, VTV, or SCHD, they are dividend-paying beasts, combining strong yields with consistent growth. The beauty of this strategy? You're not just collecting dividends, you're growing them, setting yourself up for a passive income stream that keeps getting bigger. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.